All right, let's get right into it. Today, we're tackling one of the most famous patterns in trading, the cup and handle. But here's the thing, it has a dangerous look-alike, an evil twin that can absolutely wreck your account. Our whole goal here is to give you a framework, a mental model to tell these two apart every single time. So you see the setup, right? A stock is just sitting there right near its highs. It looks perfect, like it's about to absolutely launch. You can feel the excitement. But is it a real launch pad or is it a perfectly laid trap? That's the million-dollar question, and that's exactly what we're going to break down. Okay, so let's meet our two main characters. On one side, you've got the hero of our story, the classic cup and handle. This is a continuation pattern. It basically says, hey, we were in an uptrend, we took a little break, and now we're ready to go again. And then you've got the villain, the double top trap. It looks so similar, but it's a total fake out. It's a sign of serious weakness that often leads to a nasty reversal. Now, before we even look at a single candlestick, we've got to start with the right mindset. Honestly, this is where the entire game is won or lost. It's all about understanding the psychology behind the chart. Are the big institutions buying up shares for the next big move, or are they quietly dumping their positions onto the public? That's the core difference. And this right here, this is the one rule you have to burn into your memory. A cup and handle is a continuation pattern. It continues what's already happening. A double top, on the other hand, is a distribution pattern. It's where the smart money sells. If you mix these two up, none of the other details are going to save you. This is the foundation for everything. So let's be super clear about what a continuation pattern really is. Just think of it like a healthy pit stop. The stock's been in a solid uptrend, right? It just needs to pull over, catch its breath, let some of the nervous folks sell, and then get back on the highway heading in the same direction. It's a sign of underlying strength. Now, on the complete opposite end, you have a distribution pattern. And this is a sign of hidden weakness. The price might look strong, it's pushing up against those old highs, but what's really happening under the hood is that the big players are using that excitement to quietly sell off their huge positions. They're literally distributing their shares to all the eager buyers right before the price is about to fall. And that leads to this incredibly important point. It's so simple, but people forget it all the time. Continuation patterns don't fix broken trends. You just can't have a valid cup and handle if there isn't a healthy uptrend before it. If the stock has been going sideways or trending down, it's not a cup and handle. It's something else entirely, and it's probably about to fail. Okay, so now that we have that foundational mindset locked in, let's dive into the nitty-gritty. We're going to look at the actual charts and break down the anatomy of these patterns piece by piece. This is where you'll learn to spot those tiny clues that make all the difference between a winner and a trap. All right, let's compare these side by side. First up, and this is a deal breaker, the prior trend. A real cup and handle must come after a clear uptrend. Higher highs, higher lows. The trap often just forms in a sloppy sideways market. Next, look at the shape of the cup itself. What you want to see is a nice rounded U shape. It should feel kind of slow, even boring. The trap? That's usually a sharp, angry V shape, a quick drop and a quick rebound. Volume is another huge clue. On the good setup, volume should dry up as the cup forms. On the trap, you'll see big volume spikes on the rejection from the highs. And finally, the handle. A proper handle is just a shallow, orderly little pullback. The trap either has no handle at all or the pullback is way too deep, showing sellers are still in control. Okay, now we're getting to what I think is the most critical part of the whole setup. I call it the right rim test. This is the moment of truth. How the price acts when it gets back up to that previous high, that tells you everything. It's the ultimate tell for who's really in charge, the buyers or the sellers. And here it is. This is the dead giveaway. If you see price slowly grinding its way up to that resistance level, with small candles kind of overlapping, that's incredibly bullish. That's called absorption. It means the buyers are just soaking up every single share that sellers are offering. But if you see price rocket up to that level and then get slammed back down with a long wick and a big spike in volume, that's distribution. That's sellers saying, not today, and it's a massive red flag. Okay, so we've done all this analysis. Now let's talk about execution, because there is one critical rule that I swear will probably save you from 80% of false breakouts on this pattern. It really comes down to the difference between how amateurs trade this and how professionals trade it. So just think about this for a second. The price is pushing right up against that big, obvious high.
Every trader on the planet is watching it. The temptation to just hit buy is huge, right? But where is the correct entry? Where's the spot that actually gives you the best odds?
Okay, here's the secret. The classic retail mistake is buying the second you see the price poke above the cup's rim. You're buying that second peak. And what happens? You often become the liquidity for the big institutions to sell to you. The professional method requires patience. You wait, you let that little handle form. That handle proves the buyers are for real. Then you buy the breakout above the high of the handle. Not the rim, the handle. Huge difference. All right, for our last section, let's add one final safety check. Think of this as adding a bit of a quantitative edge to our visual analysis. We want a way to confirm that there's actual, measurable strength behind this move, not just a pretty-looking chart. And a great tool for this is an indicator called the ADX. Now, don't worry about the fancy name. All you need to know is that it measures trend strength. That's it. So in a good cup and handle, the ADX should be low and quiet while the pattern is forming. Because remember, the trend is taking a break. Then as the price breaks out, you want to see that ADX line turn up and start rising. That's your confirmation. In a trap, you'll often see the ADX is already really high or even starting to fall, a sign that trend is already out of gas. And that brings us to this key takeaway. Breakouts that happen without expanding trend strength are just invitations to fade. That means if the price breaks out, but your ADX indicator is flat or falling, that breakout is probably going to fail. In fact, it's often a signal to bet against the breakout. That's how important this confirmation is. Okay, so let's put it all together into a simple 6-point checklist you can use on every single setup. Before you even think about clicking buy, ask yourself these questions. Was there a clear prior uptrend? Yes or no? Was the cup a slow, rounded shape? Did the volume die down at the bottom? Is the handle nice and shallow? Are you buying the breakout of the handle, not the rim? And finally, is the ADX turning up to confirm the move? Here's the rule. If you get 2 or more no's on this list, just walk away. It's not worth the risk. And in the end, it really all boils down to this one simple truth. Double tops fail because the sellers are still very much alive. People get trapped because the chart looks good. It looks bullish. But a real breakout can only happen when the sellers have given up. The reason these traps work so well is because the sellers are still there, in control, just waiting for the eager buyers. And knowing that, remembering that, that's your best defense.